everyone, hope you're doing well. This is the Deep Dive. My name is Drew Creekmer, and I'm Senior Wealth Advisor here at Creekmer Wealth. And I'm joined today by John Creekmer, our founder and a Senior Wealth Advisor as well. And John, we got a whole bunch of stuff to cover. It's earnings season, so there's a lot of good information out there. We're going to talk about that. We're going to talk about some economic data and some of the adjustments we are making in clients' accounts right now as we are in August, which is kind of wild to think that we are already in August. We're at the trade deadline for baseball. It's kind of crazy how fast the year's gone.
I'll tell you what, it's nuts right now. There's so much information out there. It's happening so fast, Drew. I think it's easy for folks when they hear things to kind of say, man, what numbers matter? What news matters? Where are we at? Last year was abysmal. This year was euphoric. And yeah, it's kind of been a tale of winners and big winners and not so big winners. And we're seeing some things start to shift and flip, and yet there's still talk, I think, on certain folks talking about a recession. And what does that mean? And normal indicators are flashing certain things, and yet I'm not sure what's going to happen because, quite honestly, the current economic numbers are not portending for. They're not, in other words, they're not actually showing what should be showing at this stage of the cycle with the numbers that have been out there.
Yeah, it's kind of interesting to look at that. And, let's kind of dive into some of these earnings reports because we've talked about it. I think it kind of goes along with what you're saying here, John. Ultimately, we all know earnings are what drives the stock market. And they usually have something to do with how well the economy is going, but how well a company is executing at any given point in time. And so we've talked a lot about the technology companies are doing very well right now. Their earnings are growing. But John, in your neck of the woods there down in Peoria, we had Caterpillar report today and had a fantastic quarterly report there.
I said Caterpillar blew it out of the water. They just, I'm just kind of pulling the report up now. I mean, the analysts' estimates was that they were going to earn $4.57 a share, and they actually earned $5.55 a share in the quarter. I mean, that they beat the estimate by over 20%. I mean, how can an analyst get it that wrong? Sales increased 21.8% year over year. Revenue hit 17.3 billion, which was 770 million above expectations. Huge margin expansion on a year-over-year basis, and operating margin increased from 13.8% to 21.3%. And in spite of rising production costs, so there's a lot of good happened there. And I think that we kind of think about, well, why did that happen? And so we know that there's been a certain bounce back from the whole shutdown from COVID. And so companies put off, and a lot of countries put off completing some earth moving equipment purchases. They put off a lot of their infrastructure development. And then all of a sudden in the U.S., they passed a $1.9 trillion, as far as an infrastructure bill, which is now, goodness, Drew, is that in May of last year, I believe, that got passed?
Yeah.
So those projects are not just ready to go, but whenever you look out there, I mean, I got held up in 2 construction sites today driving around. We see a lot of bridge work, a lot of road work, a lot of buildings going up. And so that's actually pushing and driving Caterpillar. And so infrastructure stocks are doing extremely well, and earnings are beating expectations.
Yeah, and I think, John, a lot of people call Caterpillar a cyclical company, right? And they're a great company to look at to give you an overall picture of how strong the economy is. And what you just laid out there really speaks to what we've seen play out so far this year. The economy is much stronger than what people expected because of some of these large investment projects that we're seeing finally come to fruition. So great to see that from Caterpillar, and speaks to the bigger picture about the economy is holding up pretty well at this point in time. And so, John, let's kind of shift gears a little bit. Let's do a recap. Let's take a look at what the different sectors of the market have done, but also what is the bond market doing? And let's start with the bond market. Right now we are in the longest drawdown in the history of the U.S. Aggregate Bond Index. So that's all the publicly traded bonds here in the United States. And the lowest drawdown that had ever been experienced was only 16 months. We are now 36 months into this bond drawdown. And so, John, why is that important, and what should people keep in mind about that?
It's so interesting. Typically, we see interest rates move in short cycles as far as in the micro, then move in long cycles in the macro. Right now, we have watched over the last year and a half Federal Reserve increase interest rates at such a brisk pace At the same time, they had already started pulling back or pulling dollars out of the economy. And you could go back and listen to some previous conversations Drew and I had on that. It's called quantitative tightening. And so it really speaks a little more educationally about the way in which the Federal Reserve controls interest rates, control money flow and demand for money flow. And so with that, they actually can increase interest rates that cuts down on demand with the same amount of supply of dollars, or they can also put dollars into the system to increase supply of dollars, or they can remove dollars out of the system to decrease supply. And so we know that the economy really expands and contracts based upon the availability and cost of money. And so with the bonds, with interest rates going up and being forced to go up, we now have 36 months of the bond market being down. It started in August of 2020 is when it first started decreasing. Now, the Federal Reserve just increased interest rates here this last week, and pretty much there's an 87% degree of probability that we're going to see another 25 basis point or 1/4% increase before the end of the year. But right now, the plot chart coming out of the Federal Reserve, very high degree of probability. The majority of the Federal Reserve governors are actually predicting that we're going to start to see a flattening as far as of the cycle early next year and a decrease starting at the midpoint of next year. This is setting up with how far interest rates have gone up. This is setting up for a phenomenal buying opportunity into bonds, not right now, but we're looking at the end of this year and beginning of next year. And so you may be seeing some opportunities right there right now. Right now, Drew, we're still loving short-term bonds and short-term CDs up to less than 12 months. But if you think about it, if rates start to go flat or decrease 12 months from now, you're going to want to make sure you're positioned as far as on your maturities.
Yeah. And John, I think that kind of surfaces a great question that a lot of folks who are maybe in that yellow zone, so they're approaching retirement, and the majority of their assets are inside of their 401k or 403b, and you have limited options there to invest. And so a lot of folks are saying, hey, what can I do? The market's gone great so far for the last 7 months of the year, but has it gone too far too fast? And if rates may go up some more, do I really want to put more money into bonds? How should people be thinking through that crucial asset at such an important point in their life?
Right now, I think a lot of it really depends upon your age, first of all. I mean, if you're over age 59 and a half and you have money in a 401k or 403b, you're really limited on protection assets. And if you're at that age, you want to be thinking number one about protection and when you're going to start drawing income more so than growth. And so with that in mind, you want to say the things you can do. You could actually do with most cases and most plans an in-service distribution. You can roll your dollars out into an IRA or a Roth IRA if you have a Roth 401k. And then from there, you have more tools available, whether it be a CD, a treasury, whether it be into some type of a managed bond position, a buffer, utilizing options for the account, or even into a fixed index annuity. I'm telling you right now, on a fixed index annuity right now, now is the absolute best time I've ever seen in my 30-year career to utilize that tool if it makes sense for you. With the way the insurance companies manage money, it's really based upon volatility and interest rates, and a phenomenal opportunity right now to basically have some arbitrage and hedging, and allow a professional to assume a little bit more of the risk than doing it on your own. So a tremendous opportunity there for some folks. So right now we're saying hold off on that, maybe harvest some of the gains you can off of your equity positions, and then also start looking at doing some rebalancing in different asset classes away from that large technology, which has been the leader by far and away so far this year.
Yeah. And, John, I think that kind of sets us up to transition here. Just take a look at how the various sectors of the markets have done so far this year. And across the board, it's been nice to see more green on the screen than red, like we had back in 2022. But you already mentioned it. Large technology companies are having a phenomenal run so far this year after getting really beat up back in 2022. And so you mentioned something about harvesting gains and looking to reposition or reallocate accounts to kind of manage for some of the risk we think is coming down the pipeline. Can you walk through why it's important at this moment in time where we're seeing a huge disparity between how the NASDAQ has done this year versus the Dow Jones, which is a more traditional value, a little bit more conservative equity position?
Yeah, I mean, the numbers this year are really kind of staggering whenever you start to look at those numbers. you're able to see some strong differences. I mean, this year we're looking at the NASDAQ. This is straight NASDAQ, unmanaged index, up
Yeah.
43.81% year to date. As of here, a recent date here on August the 1st, you see the S&P 500 up 19.27. But then you look at the Dow Jones, it's up 7.26%. It's a huge disparity there. Historically,
Right.
the Dow Jones has performed just a slightly less pace than the S&P 500, and the Nasdaq has outperformed over a longer period of time, somewhere in that 2.5% range as far as on an annualized basis. Whenever we see that level of disparity of 36% over the course of 7 months, what that means is that in time, that spread has to revert back to the mean or get back to its normal period of time. Now, we still think Nasdaq's got tremendous long-term potential. Certain sectors and subsectors and opportunities within the Nasdaq have tremendous outperformance possibilities. But right now in this season, that we see there being a risk, and actually starting to see a little bit of shifting over the last 3 weeks to where we're starting to see the Dow Jones actually in certain areas of the Dow Jones, particularly infrastructure and pharmaceuticals, actually starting to close that gap in a pretty strong base. And going back to the previous comment, the first comment about Caterpillar, Caterpillar is up huge today, and it's been on a strong run the last 4 weeks, all because of the infrastructure play. So by shifting, it's an opportunity to actually take some gain off the table, protect a little bit, but then at the same time, we're not saying cash in totally out of Nasdaq, but we are saying don't be too greedy and put some money into an underloved asset class.
Yep, absolutely. So if you're a client of ours, we actually are making those changes in your account here this week to do some of that rebalancing that John just laid out for you. But overall, we see a lot of positives. See, John, I think it's safe to say more positives than negatives out there right now, but there are reasons to be cautious at the same time. You think that's a fair summary for where we're at in the season?
Any time that we're heading into a presidential election year, as we are this next year, I think you want to make sure you have your ear to the ground and pay attention. But we've never had a presidential election season like we have right now, where the leading candidate on the Republican Party and the leading candidate on the Democratic Party both have very serious criminal investigations going on. And again, we don't get political, but what we do is we look for opportunities and also instabilities. And so that provides a lot of instability, of unknowns of what's going to happen from a legal standpoint. And so because of that, after the huge run this year, it makes sense to be a little bit cautious. And so by that, what I mean is you want to take a step back. You want to look at your goal objectives. And remember, folks, a goal objective has two things with it. The first one is time frame of when you're going to need the money. And then secondarily, the dollar amount you're going to need whenever you hit that time frame. And so based upon your personal goal objectives, right now is a tremendous opportunity, regardless of that goal objective, to really consider your asset allocation and the level of risk in your portfolio. If you had exposure to technology stocks the first half of this year, you made a large increase. But what that means is the larger portion of your portfolio is now tied to high level risk assets, which would mean that you're kind of be susceptible to a little more volatility. You probably want to make sure you have a discussion with your advisor about should you be rebalancing that in some way.
Awesome. Well, guys, that's all we have for today. We really appreciate each and every one of you. And if you have any questions, whether that be about rebalancing in your account to make sure you're in alignment with your goals, or maybe about an in-service distribution if you're approaching that retirement age in the next couple of years, absolutely reach out to us. We'd love to chat with you and see what we can do to help you out. So thanks for the time, guys. Hope you have a good one.